Hello everybody, good morning. It's 28th of July 2020. This is Prince. This video is only for educational and informational purposes only and is not to be considered as a financial or trading advice in any way. I'm not a certified financial advisor and I'm not a certified technical analyst. This is just my personal opinion. So now we've got euro dollar daily chart on the display. And now you can see it has been drinking some rocket fuel. Let me tell you some facts. First of all, the euro dollar, the low that it has made recently during this year, you could say is 1.06, and the high we have is let's consider it 1.18. And 1.18 minus 1.06 divided by 1.06 into 100, this is almost an 11.32, 11.5% move towards the upside. It has to make, in my opinion, a correction of 50% and must come back to this area. One of the reasons, okay, here's a very quick trick. The euro dollar is opposite of dollar against Swiss franc. If you zoom in or zoom out a bit, you can see they're very much negatively correlated. All right, so let's start predicting, or let's do some technical analysis. First of all, we do have an up channel. We have an uptrend on the euro dollar. We have highs, higher highs, some consolidation, higher highs, higher highs, higher highs, higher highs, and here we can see it's reaching consolidation because the next level is 1800. It's a psychological level. Plus, if you go on the daily chart, we can see this area, 1800 area. Whenever the price, even if you see the past history, above 1.18, it always slips. In the past, in 2017, it did go 800 pips above it, but it crashed down. So this is a very important level. Let's draw it for you. This is the zone. Can you see that? And you have a very decent level of resistance. You have all those buyers taking profits or short sellers jumping in this area to exit their buy trades or to make the market crash. One of the fundamental reasons that is behind this spike is that I do not have access to the resource or reference right now, that USA, they started printing dollars, and whenever a currency is being printed in trillions, it always loses its value. So dollar going down in value lifts the other currencies and gold up. That's the usual case. So, and again, everything is very predictable here. You can see the currencies, especially a currency like euro dollar, they move like annually between 800 to 1500 pips in a year. So this whole move is almost about 1100 pips. So it has to make a correction. Another trick is, usually whenever you see a strong spike up, okay, let's say this case, always the correction happens almost 90% or 100% of the size. You can see that this move was a strong move up, then it made a correction also of the same length. Even you can see here, this was a strong move around this area, strong move towards the downside, then it made a correction. Here in the past, in 2017, this whole big move started from this place, from this price around 1.05. It went all the way up. This all above is a fake out, so I do not consider it. And eventually, when the markets reversed, it came back to the same point where the whole move started. Almost 95%, it covered the same distance. So what we need right now, we know the market's been spiking up. It's been spiking up. It's moving up very hard. We need a correction. What would be our sign to identify if the market is going to reverse? We need aggressive red candles on bigger time frames like 4-hour, daily, 1 hour, or weekly. So this is the daily candle today. It has not broken the low of the previous day, but let's see how's the 4-hour chart doing. We have 2 consecutive red candles on the 4-hour chart with lower lows. This is a low and this is a low. How's the 1 hour chart? See, now the ratio, let me get rid of some stuff. You see, if you analyze, you can see the ratio of green candles is higher than the red candles, but you can see this is the only time where the red candles are coming constantly or consistently. 1 2 3 4 5 6 red candles. 1 2 3 4 5. Okay, 5 green candles, but they are not there's no follow through, right? We have 4 red candles, then 2 green candles, then 2 red candles again. Another trick is that below the previous day's low, always the bears are in control. This is not yesterday's low, this is yesterday's low here, around this area. So we have two possibilities. We could see the market tumbling at this level. It might make slight reversal, try to push back up, and then boom, it will collapse down. Okay, this is one scenario one. Scenario two could be we have a pullback and we go straight, continue the trend towards the downside, or we can just see an aggressive break towards the downside and the market retests the low and start trending towards the downside. So once we see a red candle closing below the previous day's low, we could confirm that the market's going to trend towards the downside. At the same time, a reversal pattern always looks like an M. You have a resistance. At the point of resistance, buyers are in control. They want to break up, they make a pullback, they want to lift, go break again above it, but sellers jump in, and you have this M pattern. And usually the people, they use the peak or swing low of the M pattern to short sell, and the stop losses are usually at the highs. This would be the point of selling. And you can see here, if you see very closely, we do have an M pattern here. We have an M pattern here. See that? These patterns are very predictable, very high. They are high probability trading patterns on higher time frames. By higher time frames, I mean H1, H4, and daily. They are more successful on the daily and 4-hour chart. So I hope the video helps. If you have any questions, feel free to comment. Have a great trading week and wish you a lot of success. Bye bye for now.